Hello, this is Coach Mike from winningstockcoach.com. Going to present here our market overview for the coming week beginning March 3rd, a new month, and some pretty cool, I guess you'd say, anomalies that we've been studying for quite some time with the coaches roster at winningstockcoach.com, and we've seen reoccurrence after reoccurrence throughout the process that we've been taking the time to make this study, and we are finally seeing something that's kind of coming to be, supported by several catalysts and whatnot. I want to start out by, kind of letting you know, over these past few weeks, few months actually, that I've been making the market overview videos, I've done my best to present to you factual information about the market's charting patterns that have kept you safe when the media and whoever else has tried to instill fear. During the government shutdown, I kept my members safe by producing trade plans that protected their capital. In January, when we hit our highs, and as the fall began, it wasn't until halfway through the fall that the media picked up and started scaring people out of the market to continue the sell-off. While all along, we expected market highs to be made through the last week of February and into the first or second week of March. Let's talk about how we came to that conclusion. A trading tool that many brokers will offer is a Fibonacci time extension. This is an easy way to calculate the time in a trade sequence. By marking our previous market low to our previous market high, and again to the low in the current trade sequence, we produced a time pattern based on the Fibonacci algorithms that lead us to a day to expect the conclusion of a market trading series. This week leads us to the upcoming week, or the tool leads us to the upcoming week. This is something that we've been talking about at the coaches roster since mid-November, especially, to prepare our members so that they don't have to be scared in shaky times. Now, let's look at the different aspects of global politics, global economy, all rolled into one that may finally serve in a catalyst, or as a catalyst, for a market pullback. If we followed the media over the past year, beginning in August of 2013, when the taper fears were first instilled, those media outlets began to explain to the public that the taper would be a bad thing for the stock market because the quantitative easing is propping up the stock market kind of falsely. It's a manufactured breakout, if you may. In September 18th it was, the Fed chairman Ben Bernanke decided that they were not going to taper from quantitative easing at that time due to the looming fears with the government shutdown. On that day, the market shot up to then record highs before pulling back over the next 3 to 4 weeks, as was actually typical in the trading patterns from April to mid-November of 2013. On December 18th, news was announced that they would begin tapering from quantitative easing. And the market actually reacted in the exact same way it did when no taper was announced back in September. It was kind of a odd anomaly, or was it? Indeed, if you look back at the Japanese markets when they tapered from their quantitative easing, you'll find that their markets went on a 4 to 6 week rally before a heavy fall. Much like our markets did in their 4-week rally before a heavy fall. Annotated here from the time that the taper was first announced to the heavy fall that was made here. The Japanese markets again rallied to a record high over the next 3 to 4 weeks before pulling back 27%. The word correction is not properly used until a 10% pullback or greater is seen, and they corrected 27% simply based on the tapering or reducing of their quantitative easing. The trading patterns are found to be very similar to our current patterns. The chart you see before you here is a 20-year weekly chart. I'm using the mountain chart, even though typically I prefer using candlesticks. The mountain chart gives us a nice, easy view of rises and falls where we can collectively understand the data that's being presented. If you look back in 1995, we began a rise. This was our dot-com era, our tech bubble as it was later known, where we went just 5 years and 2 months from a market low to a market high. And then the bubble popped, and we fell. On the rebound of this, beginning in late 2002, we began a 5-year trading sequence to the market highs before the housing bubble popped. And since the week of the market lows to where we are today, the upcoming week marks the 5-year mark. Now, does that mean the markets are just going to fall apart and just dive? Well, if you notice in these, the way I have the areas of the chart shaded differently, there were still a big dip, a rebound area here, a dip and a rebound, a big dip and a big rebound, a big dip and a big rebound, a big dip and some sideways, and then we got moving again. Here, every big dip was followed by a big rebound, and each time it was a lower high that was created. So though you can never predict the rate of a fall or the rate of a new trend in place, it's not hard to anticipate the possibility of, from our next pullback, beginning to see lower highs being made. As lower highs are made, we will begin to see lower lows follow in sequence. And let's talk about the catalyst that could lead us to this point. Friday was a very awkward trading day. If you look at an intraday chart for the S&P 500 on Friday, and we will go ahead and look at a 3-minute chart, you will see that Friday started off very, very strong. Very little pullbacks intraday, and then we get to the time at about 1 p.m. where rumors hit the trading floor that Russia was going to invade Ukraine. The markets quickly fell, rapidly fell over an hour-long period. Before those rumors were halted and announcements were made that, oh no, Russia is not authorizing military force in the Ukraine. So the markets began to rebound at a very rapid rate. The harsh reality of what came to be was over this past weekend, the current weekend, Russian parliament actually approved the use of military force. And it began a little bit of a uneasy disturbance and sentiment already displayed by the United States current political administration. Is that a catalyst to begin the market pullback? Absolutely. Have we had several catalysts to begin a market pullback? Absolutely. In fact, if you watch since the December timeframe when the tapering from quantitative easing was first announced, market volume has actually been ridiculously low. Very little to no market volume until the 2-week period marked here, where we had our big pullback in mid to late January. And we saw our highest volume in months. It is almost as if the jump that was created over the past couple weeks, on very low volume, mind you, is more of a false bounce or a market anomaly to simply complete an algorithmic pattern. Many people believe, there's conspiracy theorists out there that they'll believe that, the computer algorithms will never be able to beat them, will never be able to profit in our trading as long as there's computers that are algorithmically programmed to read human interaction with the stock market. I personally don't much believe that. I've been able to make plenty of money myself, and it's not through trying to fight the conspiracies rather than simply understand them and reduce my expectations to reasonable expectations. So here we are, again, looking at the weekly chart for the S&P 500. I've marked 2 periods here that most will be familiar with. We have first the tech bubble period. The dot-com era was a 5-year period from the market low to the market high. When the tech bubble popped, we began another 5-year period from the market low to the market high. And then the housing bubble popped. The markets hit their lows in March of 2009, and I think it's very, very important to be cautious of history. And I'm not saying to be scared of history. I'm not saying let's create a big massive sell-off. I am simply encouraging you to have a plan in place for when the support levels of your stocks may fail. You are prepared to exit based on what the markets are doing and not what you may want them to do. Preparing you in a way that has you not scared, but ready to act upon a decision. As I tell my members at the coaches roster, when you prepare in this way and you read these charts for what they are doing and not for what you want them to do, it allows you to make unemotionally guided decisions. Decisions that lead to profit. By reacting on what is happening and not on what we want to happen. Many people buy a stock and all they care about is it going up. They fail to see the reasons why it may go down. They fail to exit as it may continue down. And many times, even the average stock picker will see a win turn into a loss due to failure to understand and analyze the information ahead of them. Many times, you've heard the famous quote of those who fail to learn from history are doomed to repeat it. I find it ironic, not scary, that the 2 major market collapses during my adult life have been created after nearly identical to the day time patterns and nearly identical to the actual trading patterns and volume patterns throughout that time. I simply find it ironic. Ironic to the point where, though I'm not scared of it, I'm ready to act upon it. And let's face it, should the markets fall in the way that they've fallen in the past, so long as you're prepared and have the proper tools provided to you, the proper knowledge to plan for any situation, you would be encouraged to know that we may actually be presented with the opportunity to do this all again, which would be a welcomed opportunity in my book. If you looked back at the same stocks that are running hard 5 years ago, would you have not liked to purchase them 5 years ago and simply held to this time? The current bull market has run record percentages, propped up by the crutch of quantitative easing. And though I believe there will be lows and highs to be made, there will be long trades to profit off of, I believe that we may have actually come to a time where we begin to see the current trend of the market shift. Now again, that's not intending to scare anybody, because we simply need to act upon the data that's in front of us. Could this be something that just, hey, we get a slight pullback and other people see the same thing and create a massive sell-off? Well, I'm sure. I doubt I'm the only one that sees this anomaly of the 5-year market swings. But I also will not be one that is doomed to repeat history and fails to act upon a market shift. Can you make money on a downtrend in a market? Well, absolutely. Long positions can still profit so long as you don't have false expectations of new highs until higher lows are created, and you take the opportunity to trade around core long-term positions or shorter-term trade your long positions as the market retraces. Though I am not a natural bear, the longer-term swings on the long side may turn into better opportunities for longer-term swings on the short side. And though we haven't received confirmation of this at this time, I believe we're at a time where we have to be aware of the possibility and even aware of the probability so that we can properly identify situations happening before us and make the decision as it needs to be made. We're going to shorten our weekly chart down here to just displaying 5 years since the market low. And you see this teal trend, the teal channel. It's a channel that we've traded consistently between the low and high over the entire 5-year period. I spoke last week in the video about this time period where QE3, the final introduction of quantitative easing dollars, the stimulus was added into the economy. And in December of 2012, that initial $40 billion plan was raised to $85 billion. And therefore this new channel or this new trend line was created. Our January lows closed us right off of this trend line, thus giving us the anticipation of a support being hit and positive movement to validate one last run, one last hoorah, as I called it in the videos just a few weeks ago. And we get ourselves presented to the time where we still need to fail this trend line before we need to have any fears. And what I mean by that is, even though I'm anticipating myself that due to the global political news, global economic news that's been flooding us for the past month and a half, that we could have very well seen the high, coupled with that 5-year period anomaly from the last two bubble periods since the mid to late 90s. I won't be scared out of long-term positions until the support level fails. Why? Because I need to read the chart for what it is and not what I want it to be. For had I been scared out of positions on any one of these dips, I would not have made the amount of profits I'm currently holding in long-term positions. Therefore, each one of these dips that eventually led to higher highs has been worth holding because we have not failed this market trend. So that's another thing I want you to be able to identify here is even if we start pulling back, as bad as it was in January, when the media tried to scare you and I came on and started sending out videos to say, listen, don't be scared until this line fails. And as you saw, there was no reason to be scared. And again, I'm saying that there's no reason to react. There's never a reason to be scared, by the way, but there's no reason to react unless a support level has failed. I'm simply saying the likelihood of that support level failing is a little bit higher this go round, in my opinion, than it has been over the past 13 to 15 months. We're going to take a look now at the Dow Jones Industrial Average chart, the DJI. You see over the 5-year weekly chart, we go from a channel in the market lows into our current time, and we've traded between the low and high of this channel. We have that same time period of the week of November 12th, 2012, where this new channel was created. And oddly enough, and different than the S&P 500, we saw the January pullback fail this shorter term channel. And the rise, and even a little higher rise, fail to penetrate and retrace us back above that failed channel, thus establishing a resistance. And though the line is still moving up, and our price moved up to a new high this past week, unlike the S&P 500, we did not move on to a record high. In fact, we stayed still fairly congruent with that head and shoulders pattern that is a bit of a bearish indicator once what we call the neckline is broken, which would basically be the low set here. If it were to set a lower low, the neckline would be broken, and we would expect a bearish pattern. Because of the current trade pattern in the Dow Jones Industrial Average, I believe that any subsequent pullback now that even exceeded the low of last week, or the prior week's close, I should say, would be even further indication of a bearish signal and could cause quite the pullback and sell-off throughout the markets. And again, I have this opinion coupled with the news coming out of Russia this weekend and the reaction the markets had on Friday when that news turned into false news and now has turned back into, no, that was real news. We saw the markets dip from 1 to 2 very heavily on Friday because of the news that Russia was going to invade the Ukraine. Then when the news turned into just a rumor that was not verified, the markets rebounded. And now we're posed with the fact that it is now news. So I believe we could see that reaction in the market in the coming week. The same as we saw on Friday afternoon. And finally, our 5-year weekly on the Russell 2000, the RUT chart, small cap index. We talked last week about the failure of that same trend line that was started the week of November 12th, 2012, and through the bumps when QE3 was stepped up and ramped up, the failure of it, and then the retesting of it. Well, this past week it did close very, very well. But if you notice, it actually again closed right at the upper channel line. And each time we have hit the upper channel line here in April of 2010, here in April of 2011, here in January of 2014, we got a very heavy sell-off that coincided with the move made after the top of the trend was hit. Due to the failure of the supporting trend line here and the, what I would have to say is barely breaking back above it, but still breaking back above it, a second failure of the trend that began with the QE3 introduction would be a support failure that I would not trust at all. Personally, I've already exited most all of my small caps. I believed personally back in early January that even if they went higher, they couldn't go much higher. And as you can see from the videos I put out, if you went back to my YouTube channel and you observed those videos, I stated that very thing. And even on this high, they have not squeezed out much higher. And I didn't have to forego the fall in January because I simply just did not believe that the risk outweighed the potential reward at that point. That's a decision that could have burnt me. In this particular case, I think it helped me. I sold off the market highs and was unaffected by the drops that incurred. I want to encourage you moving forward into this week to not fear and not sell everything you own, but to weigh your options and have a plan based on what may happen. I'd hope that you would use the simplicity of these videos to assist you in your trading, to understand these simple channels and trend analysis that I've provided to you so that you could be able to see why these particular trends are made, when they were made, and what were they in correlation with when they were made. Use them to understand that when the key supports are failed in the indices, it will have an effect on associated individual stocks. And this week, though I don't recommend you be fearful, I recommend you be on high alert, because as we complete that 5-year period, similar to the dot-com era and the tech bubble, similar to that subsequent rise in the housing bubble, and now our current rise in the QE tapering, and the failing of emerging markets and global economies, the decrease in credit rating throughout the Eurozone, and even the struggles in the world's largest economy, the United States, the economic struggles in the second largest global economy, China, and now the pending threat of what I still would call a major world superpower, Russia, authorizing the use of military force against a United States ally. Being a former military member myself, I have a good understanding of what ally means and what obligations you have politically to someone that you call an ally. So does it make me fearful of the situation? Not at all. Does it make me willing to react based on particular market reactions and prepared to react based on the historical data I've used to prepare my own trading plans? Absolutely. This is Coach Mike from WinningStockCoach.com, encouraging you to have a plan for your trades, to execute the plan when the situation arises, and not to fear the plan or any situation presented by the media or any other such source. Use the data that you see, coupled with a plan based on a risk management strategy you're willing to accept. And you'll never have a reason to fear the markets. I hope you come join us at the Coaches Roster. You'll find me live in our premium chat room every day during market hours and well into the evening hours and on the weekends, looking to assist you and partner with you to assist you in developing your own trade plans and how to actively profit with your own portfolio. Should you decide not to, that is fine. I also offer a free newsletter called the Practice Squad. I offer regular educational materials to traders as well. And I encourage you to take that opportunity because the world is a wealth of knowledge. And the day you stop learning, you die. Don't ever be afraid to learn new things. Don't ever be afraid to better yourself. And best of luck to you.